today's part with the following interruption for a public service announcement.
Welcome to Investing in Intelligence, where we talk about artificial intelligence companies, stocks, and trading using the most advanced AI models in the world. Just a quick reminder that nothing that we say here is investing advice, it's just personal opinions. Not a personal opinion, though, that the S&P is up 2.8% year to date, the NASDAQ is up 2.2% year to date, and our portfolio is up 5% year to date. But I do need to be fair, and I do need to admit the main reason for that is just a handful of stocks, especially Coreweave, Circle, Nebius, and Applied Digital. Okay, so Coreweave up 300% over the past few months. Nebius is up 78%. Applied Digital up 58%. And Circle, last but not least, up 390%. Now, you may have heard on a couple of the IPO days this year that the IPO opened at a certain price and then it was up a massive amount on that first day. And you may have felt like you just missed out. I want to reassure you and let you know that this system is rigged. So let's take Circle, for example. The official IPO price was $31 per share. But by the time you could actually click and buy Circle shares, it was already at $69 per share. Now, I actually had orders set to buy it at anything less than 34. The orders never even went through. In other words, it didn't really IPO at 31. If it had really IPO'd at 31, my orders for it at 34 would have gone through. But in actuality, by the time you could even buy it, it was at $69 per share. But we bought it at $69 per share, and now it's quite a bit higher. It's okay to make all your returns from a few bets. For example, few know that Berkshire Hathaway actually made almost all of the returns over the last 10 years simply from Apple stock. Actually, 3/4 of all Berkshire Hathaway returns over the last 10 years are solely from Apple. If they hadn't bought Apple, they wouldn't have done all that great. Now, it's important to understand when you're investing in something, you want to try and get advice from whoever knows that thing best. For example, in the world of AI, I would say that Gene Munster and Stacy Raskin are the most knowledgeable experts on that topic, not Jim Cramer.
I want to see if I should be backing that truck into Nebius.
No, I saw the Nebius booth. I was at the Nebius booth at the GTC festival, but I have to tell you, I'm not recommending stocks that are losing fortunes, and Nebius is losing fortunes.
So that was Jim Cramer saying not to buy Nebius 3 months ago, and anyone who listened to him missed out on 78% of profit they could have made. And actually, it was kind of the same story with other things, especially Coreweave. Everyone in the mainstream financial media was knocking Coreweave and saying how it has so much debt and so on and so forth. Well, look at Coreweave. It was probably one of the best buys of the year. Just so happens in that same episode, Jim Cramer actually mentioned one other company, though, that piqued my interest.
My question is about Western Digital. What do you think about it?
Western Digital is it's just too commodity for me. I can't get behind it. I'm very sorry.
Now, Western Digital is up nicely since that episode. So obviously he was wrong about that too. But how wrong was he? So we asked ChatGPT o3 Pro, which is the most advanced AI model in the world, obviously by its $200 a month price tag, if Western Digital and its competitor Seagate Technology are a buy right now. And it said yes, and it prefers Western Digital. Why? Because it has 58% year-over-year revenue growth, and its NVMe drives are inside of NVIDIA's new Blackwell servers, giving it a seat at the highest growth premium portion of the AI stack, not just the bulk storage backend. Now, with both flash and HDD lines, Western Digital, or ticker symbol WDC, has diversified exposure to storage. It participates in both the ultra-fast model training tiers and the capacity tiers. Also, it's cheaper. If you look at forward earnings, so if you look at a forward PE, it's only 10 times revenue. So you get a higher growth for lower cost than you do with Seagate. Now, Seagate does pay a 2.3% dividend, but O3 Pro said its single product focus and already full valuation make its risk reward less compelling than Western Digital right now. So we bought both on May 7th, and we're up 29% on WDC, Western Digital, and 39% on Seagate. By the way, if you want to know when we're about to buy something that's about to go up 29% or 39% in the near future, make sure to subscribe to our show. Make sure to subscribe to our YouTube if you're listening to the podcast, and especially our Twitter account. Anyways, we're buying more Seagate and Western Digital on any pullback. But really, the overall economy will determine the direction of these stocks and all stocks more than anything. So, where do we stand on that? Well, it just so happens we had the highest weekly jobless claim in 8 months last week and the lowest ISM services number in 12 months. And we know we're a service economy, so that's kind of a deal. Economy is definitely slowing, but no one seems to care too much. It would seem that if the slowing happens very gradually, the market isn't as sensitive to it as if it happened suddenly. But I will say that the lines in the sand still matter. And what are those lines? Well, we know that if we see initial jobless claims, the weekly number, over 260,000, we're in trouble. We know that if the total monthly non-farm jobs added is less than 125,000, we're also in trouble. And the ISM numbers, well, there's an ISM services and an ISM manufacturing. Service is probably more important since we're a services economy, but we know that if the ISM numbers come in less than 45, we're also in trouble. You should probably write those numbers down. So initial jobless claims, weekly number above 260,000, total monthly non-farm payroll jobs added less than 125,000, and then if the ISMs are below 45. You can find that data on the Market Watch economic calendar. It shows you all those numbers every week for free. And spoiler alert, we haven't hit any of those numbers yet. And we really aren't even super close. If the White House has any say in the issue, we're not going to because stimulus is coming soon. So the White House realized the economy is gradually slowing and needs stimulus, not budget cuts. That caused the Trump admin to turn against Elon and was a driving force for its big, beautifully stimulative bill. There are a couple problems, though. So, as of today, the Senate wants to make changes to the big stimulative bill. But if they touch the SALT cap, the whole bill is dead. That'll be under negotiations between the Senate and the House in the coming days and weeks. The other problem is the mistakes that the administration keeps making related to their attempts to raise money. So Section 899 in the same big stimulative bill increases taxes that foreigners pay on dividends and portfolio-based income. While it's not a direct capital gains tax, it will discourage foreigners from owning U.S. stocks. That's not good for your stocks. Neither is, you guessed it, tariffs. The market seems to be forgetting about tariffs right now, but it shouldn't, since the overall tariff rate is 20 times higher on China right now and 9 times higher on everything else than it was just a year ago. The tariff war with China is especially problematic. Did you know that the current minimum tariff rate for goods from China is 37.5%, while most goods from China are being taxed at 55%? And did you know that all of that tariff cost is being paid by US businesses and US consumers? So the stock market is still going to be a bit contained until we know for sure that tariffs aren't going to cause a big decrease in economic activity. So we can grind higher from this point. We just can't really fly higher until we know for sure that tariffs aren't going to sink the economy. But don't get caught up on things that aren't important over the next few months. What's not important? Inflation reports. Since tariffs are damaging the economy, inflation will probably stay tame. Interest rates. The 10-year has been in a range of 3.8 to 4.8 for literally 2 years. As long as it stays in that range, it literally doesn't matter. Corporate earnings. If you own the right AI stocks, then congratulations, corporate earnings will be good for years. Now, if you buy stupid things like Starbucks or UPS or McDonald's, and I'd probably even add Apple to that list, then don't expect corporate earnings to work in your favor. But what's the latest thing that you should be terrified about? As of today, Iran has fired over 400 ballistic missiles into Israel, but they're estimated to have 2,500. Yes, 120 of the 360 Iranian ballistic missile launchers have been destroyed, but they're still shooting ballistic missiles into Israel as of a few hours ago. In other words, this war can go on. And we know that closing the Strait of Hormuz would move oil to 130 in no time. But do not fear. China and Russia have apparently told Iran not to do that. And it's pretty much assumed that Iran won't try to close the Strait of Hormuz because it's a guarantee that the US will get involved if that was to occur. That being said, it seems like the US might get involved anyways, since the US has started moving refueling jets to the area, and Trump left the G7 meeting early and interestingly said something about everyone should leave Tehran. Regardless, historically, war is typically good for the US stock market, not bad. So I wouldn't pay attention to that either. The only thing you really need to be worried about over the coming months is tariffs causing an economic slowdown that dips us into the danger zones I mentioned earlier on unemployment claims, jobs added, and ISM numbers. Keep in mind that China is winning the tariff war against the US. Chinese retail sales data earlier this week was highly positive, showing their economy is looking up, and why not? Chinese exports to the US are less than 3% of their GDP. It's a manageable number. But over 70% of what's sold to us on Amazon is from China. These tariffs hurt us, not them. And China made that painfully obvious when they cut off critical minerals from us for a few weeks, and we had to threaten to deport every Chinese university student in America just to get our minerals back. So, although we're not making any forward progress with China on trade, China is making forward progress without us. You've heard me talk previously about how China has the best AI video models, which is still true. But did you know that China is currently making the only publicly available humanoid robot? That's right, even you can buy one. There's 2 stores in the US selling them for $20,000 right now, and they're pretty incredible. Been watching videos of them cooking, doing karate, dancing, all sorts of stuff. It's called the Unitree G1. Google it or ChatGPT it, but then you wouldn't be seeing any videos. Coming soon, I'm sure. Also, in May, BYD sold more EVs in Europe than Tesla, despite facing much higher tariffs than Tesla. Their sales volume is up 359% year over year, while Tesla's is down 49%. In other words, China, which long ago beat the US in drone technology, appears to be poised to beat the US in both EVs, humanoid robots, and big swaths of AI. When I say beat, I really just mean they're going to be the dominant market player worldwide. So, does that mean that you should rush out and buy Chinese stocks and ETFs? Well, we're actually not quite so keen as we were in our last episode. We even sold AliBaba, ticker BABA, but we're holding on to Baidu, ticker BIDU, and our ETFs, our China ETFs. The problem is that China is going to defeat the US, but not necessarily its companies. So, what do I mean by that? Well, take, for example, BYD. The BYD electric car I told you in our last episode was $10,000. That same car is now $7,000. And even though Brazil has said that BYD treats its employees like slaves, I still don't see how you can make much profit by selling an EV for $7,000, even with slave labor. And the $20,000 humanoid robot is really, really impressive. It's, according to reports, very solidly built also. So I doubt Unitree is making much profit on that either. In other words, China, the nation, will sacrifice profits of Chinese companies to achieve global domination. And that's not always good for your Chinese stocks. Maybe it would be someday, but not in the near term. On a positive note, the UAE just bought ChatGPT for every citizen in its country. OpenAI just scored a big contract to provide AI to the Department of Defense, and ASML is finally available for purchase in Robinhood. So AI stocks are popular again, which feels kind of weird because it was like just 8 weeks ago that we were so hated for being AI investors. Everyone was tapping the unsubscribe button as quickly as they could. But this is how it's going to go for years. There will be time periods when AI stocks are popular, like right now, and there will be other time periods when people say the AI trade is over and dead. But it just so happens it's actually not a trade. It's the new internet, or, as I suspect, something much, much bigger. So don't allow yourself to be stuck communicating via messenger pigeon when super intelligence arrives in a year or two. I should reiterate one warning, though, on one particular messenger pigeon.
I put in my estimates, them getting really hit from search next year and the year after. But then a day later or something, the paid clicks came out in the 10Q. And we saw that paid clicks are already decelerating at Alphabet. And on their conference call, they said everything was great. And then you realize they increased the cost, the click charge, which we don't think is going to happen forever. If the rate of return on your ads are going down, you're not going to be able to charge more all the time to make up for a weakness in clicks. So I just think it's classic innovator's dilemma. It's a great company. There's probably a lot of people watching it from the company right now saying, I can't, we're amazing. But it doesn't, when you have the innovator's dilemma, the best model like Gemini doesn't always win. You have to disrupt yourself and go.
That's not the only way that Google has been cheating. They've been cheating any way they can for several quarters now, especially by increasing pricing for Workspace and changing the way Workspace contracts are handled to lock users in at higher prices. Google is continuing to lose the AI war. And no, their VO3 video tool isn't really that impressive. Actually, China's Kling is way better. We've been warning you for over a year now that Google would underperform other AI stocks. But I don't want to say it's a worthless stock. Their Workspace business, plus YouTube, plus Waymo, plus DeepMind is probably worth $1.6 trillion alone, not even considering the search business. In other words, I'm a buyer once it gets to $1.6 trillion market cap, since I think their search business is toast. That's 25% down from its current price. Or once it gets to a current price of about $135. Remember, I'm not saying that Google doesn't go up from here. It might get dragged up with other AI-related stocks. I'm just saying my personal opinion is that it doesn't go up as much as those other AI stocks.
The first revolution is when you change your mind about how you look at things and see that there might be another way to look at it that you have not been shown. You will not be able to stay home. You will not be able to plug in, turn on, and pop out. The revolution will not be televised, and be no rerun, brothers and sisters. The revolution will be live.